Hey everybody, can you guys hear me? Throw me some love if you can hear me. Yes, all right. So here we are, 3 p.m. Thank you for being punctual. Welcome to Monday. I was going to say September 17th, but it's November 17th. It is my dearly departed dog Maxie's birthday today, November 17th. He passed away a few years ago. So anyway, we're going to rock and roll, right? So I had a couple questions already. I had a question on email. I had a couple questions here. We're going to go through the positions that we did last week. Stay tuned. I didn't have an opportunity yet to open a new account. I will be opening a new account super soon. I think I just need to make the time to do it, maybe over the next couple days. I want to record a video while I do it as well, and I'm going to put that on YouTube. That way I can walk through all the screens, how you open an account. Sometimes people have questions. I don't have options approval. How do I answer those questions? They ask you, about what your experience level is and that sort of thing. So I wanted to make a video while I do it. My kids have been, well, actually my son left the other day and my daughter's still here. And so I've been busy kind of with some family stuff, but I'm going to be doing that over the next couple of days. And then instead of showing you this paper account, I think you guys can all see my screen. Yeah. Just let me know in the chat if you can't see my screen, but I think you can. This is a paper account, and I guess I never realized that paper accounts have restrictions, right? As far as putting an order in, and then sometimes it doesn't fill. So it's really annoying. So I am going to open a new account, so it's separate from my main account, and I'm going to open it with $5,000 because I know a lot of you guys say, "Hey, I'm just starting," or "Hey, I don't have a lot of money." How does that work? How much money can I make? What kind of income can I make on a regular basis? So that way we can walk through all of it together. How does that sound? Show me some love if that sounds amazing. I'm going to be doing that over the next couple of days. So stay tuned for that. Let's start. I'm going to get to your questions in a moment, but let's start with this. Let's start with the stuff that we did last week, right? So we have right here, this is my platform. This shows my current positions. And again, when I have a real account, I look at my positions on the Schwab page and not the Thinkorswim page, because I think the Thinkorswim page does not show you as much information, and I'm also not used to it. So it's going to be way better in the next few days after I open that new account. Oh, look at all the hearts. Oh, I love it. Keep it coming. Keep it coming. So let's see what we have. So we have 100 shares of IBIT, right? IBIT, or as the person corrected me recently, IBIT. I'm going to keep saying IBIT, potato, right? I have 100 shares that I purchased at $59.50. And where is Bitcoin going? Oh my gosh, it's like going to the floor, right? No, not necessarily the floor, but let's see where it's at. BTC price USD, $91,000. So it was like, I don't know, over 100 recently. And that's why IBIT is sliding, right? And that's okay, because what does Bitcoin do? What do stocks do in general? They go up, they go down. And when they go down, it gives us an opportunity to sell a put and make more money. So let's do that first before we even get started, right? So I have 100 shares of IBIT at $59.50, and right now IBIT is at $51.74. So we're going to look at the chart, and here's a 1 year chart, and then we're going to look at the day, right? 1 day, 1 minute, and oh my gosh, it's sliding. It's totally okay. Things always go up and they always go down. We have to rewire our brain so we understand that better, right? Let's see how much the puts are going for. Now, if the stock is going down, IBIT right now is down 3.31% from Friday. If the stock is going down, are puts more expensive or less expensive? What do you guys think? Put it in the chat. I got my chat up right here. Or puts, and I think I have a 5-second delay. I should take away that delay for the chat. I think there's a 5-second delay from the time that you guys input a message that I see it. When a stock is going down 3%, are puts more expensive or less expensive? Yes, good job, Lorena. Bad job, Pamela. They're more expensive. I'm just playing. I'm just teasing. So puts are more expensive. And by the way, before I forget, yesterday I did an amazing event, 2 hours. I think we went like 2.5 hours. It was so good. And I'm going to put that on YouTube. So I only had 100 seats open. It was free, by the way. And I had 100 seats open, and it filled up, I think, in 3 days after I posted it online. And that was yesterday. I'm editing the video now. I'm taking out like the dead air or whatever, and I'm putting that on YouTube. Hopefully today, maybe tomorrow. So check that out. It's going to be really, really good. For those of you who said puts are more expensive when the price is going down, that's absolutely correct. Puts are more expensive when the price is going down. So we want to make more money, right? So let's take a look at IBIT, and let's look at this week. And also I'm going to show you a couple of other things as well. So right now IBIT is $51.99, and we own it at how much? $59.50. So I'm going to look at selling maybe a $50 put. Let's see how much the premium is going for. Strikes are down the middle, right? And puts are on the right, and calls are on the left. Let me just pull up a calculator here so I have that ready as well. And we're always going to calculate the rate of return, right? So a $50 put right now, last traded at 65 bucks. There's a 28 delta. Listen, there's not a lot of information that you guys have to look at. Delta. What is the statistical likelihood that the price is going to go from where it is below the strike price before the contract expires? What's the implied volatility? The higher the implied volatility, the more swing the stock has, right? But we're making more money, right? And in addition to making more money, there's more opportunities for that bit of a pop. Now, because I have 100 shares at $59.50, and right now the price is a little bit less than $52, I could do one of a couple things. I can either buy shares and average my cost down, or I can sell a put. And puts are like kind of free money in the sense that I'm going to get paid. I'm going to get paid right away, put it in my pocket. I'm going to keep that money no matter what happens, and I'm only going to buy the stock if it goes down a little bit more. So I prefer to sell a put as opposed to, let's say, buying more shares because I'm getting a little bit more money, right? So let's calculate our rate of return. Let's see. So the bid 68, ask 70. The last trade was 66. I'm gonna go based on the bid, right? Because if I'm selling at the bid, I'm automatically, there's already a buyer lined up to buy that contract. So I will automatically get filled, right? So let's say if I got 68 bucks and I'm putting up 5,000 bucks and I'm doing it for the week, well, gee, I'm making 1.3% on my money. If I did a trade like that every single week, I'm going to be making 50, I don't know, 60%. Let's do the math. Times 52, right? 52 weeks in a year. I'm making 70% on my money. This is easy stuff when you do that. Now, also, I put spreadsheets in YouTube the other day, 2 spreadsheets that I created. They're super cool. And they help you kind of, okay, well, if I have 100 shares at $59.50, and then I buy another 100 at 50, where does that put my average cost? So the spreadsheet does it automatically, but you can also use a calculator. $59.50 plus 50 bucks divided by 2. That means I'm going to have 200 shares at $54.75. So I only need a less of a pop back up to get rid of my shares. Do I want to hold on to shares for a long time? No, I just want to use them. I want to use them and abuse them. That's what I want to do, just to create myself income, right? So let's sell this before any more time passes. I'm going to click on the bid. Now, Nikki had asked me in email, like when I put an order in on a contract, when I sell something or when I buy something back, do I do it at the market or do I do it at the bid? Do I do it at the ask? What do I do it at? So I want you guys to understand this. When you're trading, this is how I do it. Listen, this is all education. I'm just here to help you. I'm here for free to help you. And so that said, in full disclosure, you got to make your own decisions. So I'm here just to kind of guide you. But when I do things, here's how I do it. When I'm buying or selling stock, right? Let's say I was buying 100 shares of IBIT or selling 100 shares of IBIT. I'm going to do it at the market. And it's going to fill wherever the market price is. When I'm trading an options contract, I don't use a market order. I either sell at the bid or maybe a little bit higher than the bid. You'll see the spread here. This is called the spread. 70 bid, 72 ask. That's like the spread between the two. It's kind of tight, right? If it was wide, it would be like maybe 70 bid, 80 ask, right? That's like a wide spread. This is a narrow or a tight spread. I'm just going to sell it at the bid. Now it's going up. It was 68 bucks. Now it's 70, right? So I'm going to click on the bid, and I'm going to leave. I'm always going to like look at both areas of the screen together, right? So I had to like move this, right? The option chain. Now it's 69. I'm going to try to just get 70, right? So I'm going to sell one IBIT November 21 $50 put at 70 bucks, right? Confirm and send, and now it filled, right? So now we're always going to make sure we did the right thing, because sometimes, even me, I make mistakes sometimes. I buy something instead of sell something instead of buy something. So you want to always check that. Now, if it was a real account, I would check it on the Schwab page, the positions page. I'm going to show you that once I open that in the next couple days. But in the meantime, I can see it also here, right? So here is where my long shares are. Long shares are like you own 100 shares. And you can see that by the plus sign, right? I'm not short shares. By the way, you can short shares if you think the price is going to go down. But we're not gamblers. We're just trying to make income from week to week. And we're going to talk about Big Bear in a minute. And then here's my option contract that I just sold, right? So 21 of November, $50 put. -1 means I sold it because I took cash in my pocket. I actually got a little bit better of a price. The trade price was $72, right? And so that's my contract. And now, so that's where I'm going to see that, because I want to make sure that I sold it instead of bought it. Make sure I didn't make any mistakes. Yeah. So the other thing is, let's talk about our Big Bear as well. And then I'm going to get to your questions also. I'm so excited that you guys are here. How many people are on, Nina? Can you tell? There are 81. 81. Awesome. To all you 81 people, big love. And first of all, pat yourself on the back that you're making this effort to learn. And why are you guys here? Put in the chat. Why are you here? Are you here because you want to, like, I don't know, create some extra cash for yourself every week? What do you want to do with that cash? Do you want to, like, I don't know, pay for your kids' tuition? Do you want to go grocery shopping? Do you want to buy a new car? Do you want to go on vacation? Do you want to quit that job that you don't like anyway? Are you getting ready to retire and you want to make sure you got some cash in your golden years, right? Like, why are you here? To earn cash for retirement? Amazing. Create income, but create income for what? Like, I encourage you guys to, like, spend some time and think about that. Why do I want money? Do I want money so I can, like, look at this amazing view over here on the 70th floor, and I'm looking at Fidei over here, Brooklyn over here, and that's the East River, and I don't know, I think that's the Brooklyn Bridge. I'm not even sure. Or like, what do you want to do with your money? So, and the reason why I say that is because when we take some time and think about things, it's not just trading. It's like life in general, right? Like I don't want to say spirituality or this, woo-woo type stuff, but like it's very beneficial to take a moment and think about how your life would be different once you learn the basic concepts of trading. Only 2 strategies: sell a put, sell a covered call. When you get experience, right? So sometimes I work with people one-on-one, and I was working with somebody earlier this afternoon, and she said, "How does that work? What's the Michelle playbook?" Right? She refers to it. Because she's kind of a little bit more advanced, and we were talking about, okay, well, if you want to buy your contract back, how does that work? I want you guys to know this. When you start, you put in a little bit of effort to learn 2 strategies: selling a put, selling a covered call. And then once you're kind of like got your feet wet and you have some trades in, it's like finesse. It's like dancing. It's super easy to make money, not as easy not to lose it, right? So you want to always like maintain as little amount of risk as possible. And when you're doing that, you're buying some stuff back, perhaps to take the risk off the table. So that's what these live streams are going to show you, is like on an ongoing basis after we have a trade on, like, how do we look to minimize our risk? How do we look to like get out of that contract, right? So let's take a look. I'm going to get to these. Let me read read some of these comments as well. Live in the Cayman Islands. I love it. I love it. The Caribbean is amazing. I lived in the Virgin Islands many years, 10 years, something like that. And it's amazing. And think of what your lifestyle would be. So spend some time and think about that. Help family. I love that. Absolutely. Let's do some Big Bear stuff too, because we have this Big Bear here as well, right? Michelle is the best teacher, hands down. Hello from Athletics. Oh my gosh. I am, first of all, I feel blessed and I feel honored and privileged to be able to share my information with you. So earlier I was talking and I was like, okay, like sometimes somebody had put on my YouTube channel recently, why are you telling all this to people like you're gonna wreck the strategy. I'm not wrecking anything. Listen, your success only enhances the world. It makes the world a more beautiful place, right? I live in abundance. I don't live in scarcity, right? So I don't think the options market is gonna collapse because I got 87 people on YouTube right now on this live stream that are taking action. Oh, I love the hearts, by the way, that are taking action to better their life. I love it. So yeah, so I'm happy to be here and I'm honored to be helping you. And I encourage your questions, right? So let's go through this Big Bear because I have 100 shares of Big Bear that I paid $7 for, 701 to be precise, right? And let's take a look at Big Bear right now because oh my gosh, it's down almost 10% today. The best time to sell a put is what? When the price is down. So let's look at selling a put, and if I have to buy the shares, what am I going to do? I'm going to average my cost down. Now it's important to make sure you have enough cash as you're going. I'm in the process of making new applications to make it easier for people to just kind of plug things in. Like here's my account. My account is X dollars. Here's my positions. Do I have enough money to keep averaging my cost down, right? Because it's very easy to make money and we don't know when the bottom is going to be, right? So we want to make sure we have enough to sell a put as it goes lower and then perhaps sell another put or more puts as it goes lower than that. The most important thing is it a good stock? Like, do you believe in that stock? So let's look at Big Bear. It's $5.49. Holy cow. Now, when a stock, I want to throw this out because I never really talked about this before. When a stock goes down a lot and it's like only a couple dollars, it's still far away from, a bit far away from a couple dollars, right? But when it goes really low, you want to be concerned about this. And I don't know if I have any videos. I'll have to make a video soon on this. You want to be cognizant or conscious of a reverse split. Who trades, I think it's called Yield Max, something Max. Misty is one of the tickers, MSTY, or I think there's ULTY. I think it's called Yield Max. They're like exchange traded funds that are leveraged. If anybody trades them out there, I know that there's been a couple people on my channel that have put comments about that. There's like 12 of their tickers right now doing a reverse split. So reverse splits are terrible. And here's why. I just want to talk before we go do a trade on Big Bear. Before I lose my train of thought, I want to empower you with this information that maybe you're not aware of. A stock can split, right? So Netflix is, I think, split already. Let's look at Netflix as we're looking at this stuff. So let's add NFLX. Netflix, I think, split 10-1, right? So that means Netflix was $1,100 a couple of days ago per share. Now it's $110. So let's say, I'm just going to use basic, I'll use 10-1 because that's kind of easy numbers as well. But I'm going to say, let's say Netflix is $1,000 last week. I think it was $1,100, but let's say it's 1,000, right? When it splits 10-1, right, the price becomes from 1,000 to 100. So it divides by 10, and then the number of shares multiplies by 10. So when a stock splits, like a regular split, it's really good for the stock because what it does leave you with the same value right after the split. So if I had 100 shares at $1,000 and then it splits and now I have 1,000 shares at $100, the math is the same. The market value of that stock is the same. However, what it does is this. It attracts more people into the marketplace. And as people are buying stocks, it floats the price up, right? So what affects the stock price? A big part of what affects the stock price is people buying or people selling, right? So what happens when it's $1,000 stock? Maybe people can't afford to trade it, or as many people. Not that many people can afford to trade it. But once it comes down to $100, now you have a bigger pool of people, right? So now more people are trading it, and it floats it back up. So that's a split, right? Now think of a reverse split in the opposite way. So these Yield Max ETF funds, which are fucking garbage, by the way, and I think that they're all out crooks. I'm going to pull this up and show you. MSTY, I just want to show you real quick. Yeah, Yield Max, right? So if I look at Yield Max, Google is an amazing thing. Let's just click into Google. Now, Yield Max, MSTY, it's called the MSTR Option Income Strategy, right? So the MicroStrategy Option Income Strategy ETF. That's the name of the ETF. If I scroll down a little bit, The fund does not invest directly in MicroStrategy. They're a bunch of crooks. Listen, Wall Street is full of crooks. And here's just like an example why. My kids tell me, my daughter most specifically, you got to be careful like what you say on YouTube. I'm going to be like who's that guy that got murdered? I forget his name. Anyway, she says I have to be careful on calling Wall Street crooks. But in my view, they are absolutely crooks, right? And because they call themselves a MicroStrategy option income ETF, but they don't even invest in MicroStrategy. And what they do is they tout this high yield strategy, right? Like you're going to make 20% on your money. However, it comes from the erosion of the NAV. And what I mean by that, and I don't want to give you guys like big words that like, I want to keep it like regular everyday talk. The actual price of the ticker pays a good chunk of that income. So really what they're doing is they're kind of like pretending to be, it's like a sheep in wolf's clothing a little bit, right? And my point, without getting too much on a tangent, maybe we're going to go a little longer today. And this is going to be recorded. So if you have to drop off, just catch the recording on YouTube. It's all good. And my point is this. YieldMax is doing a reverse split on like a dozen of their ETFs. And so a reverse split is this. When something becomes super, super cheap, now who wants to invest in something that's like 50 cents or $1 or something like that, right? So Misty is $7, so it's not super cheap yet. But a reverse split means now the price, let's say it's $10, now it becomes, if it's a 10 to 1 or 1 to 10 reverse split, now it becomes $100. So it becomes a little bit more attractive to people. But what happens is if it's still garbage ETF, which in my view it is, it just brings the price back down again. I remember a long time ago, 2007, 2008, who remembers the financial crisis, right? When Lehman Brothers went bankrupt, they were like the powerhouse of the financial institutions. I think it was trading our Royal Bank of Scotland. It was a bank stock, and it was an amazing bank stock. And they split, I don't even remember what it was. I think it was like a 12 to 1 split, or 1 to 12 rather, reverse split. They did a reverse split. That stock never recovered. So my point is this. That was a long-winded way to get at my ultimate point, but my point is this. When a stock becomes super cheap, you want to be conscious of, oh my gosh, I hope that doesn't do a reverse split. And if you're trading anything that is set to do a reverse split, you might want to look at running the other direction. Taking the loss. Listen, we never want to take a realized loss, but sometimes we end up saying, you know what? I thought that was a good ticker. I thought that was a good stock. I thought that was a good ETF. And you know what? I don't think it is anymore. So sometimes it's better, take the loss before you lose all your money and then put that money somewhere else. Okay, so let's go back to Big Bear, and then I'm going to go to your questions because I think I have a bunch of questions here. What was I doing? I was going to sell a put on Big Bear. So let's go back to BBAI. It's $5.47 per share, and let's see how much the puts are going for. This is a good stock to learn on, I think. A $5 put, $9. I know it's not a lot of money, but you want to look at the percentage, right? So $9 that we're making in income. We're putting up $500 in capital. We're making almost 2% for a week. That's not bad, people. I'm not saying trade this. I'm just saying maybe look at it. You're making, if you do a trade like this once a week, you're making 93, almost 100% on your money. So let's just do it. Let's click on the bid. And what am I going to do? Am I going to sell it at the market? No, I'm going to sell it at the limit price. Limit means this price or better. I'm going to sell it at the bid price of 9, right? 0.09. And I'm just going to hit confirm and send, and I'm going to send. Okay, bam, we filled in the upper left here. Now I'm going to go to some questions. I'm so excited that you guys are here. I love teaching. I feel like teaching, first of all, I think I'm good at it, and I'm also passionate about options. When you do something that you're passionate about, it's like it makes work not work. Not that this is work because I'm not even getting paid, but it makes it fun, right? Is my point. So I'm going to start with somebody that was talking about Webull and Eli Lilly. So Option Queen, I love that tagline, Option Queen. So let's look at Bull. Webull is Bull. I never traded, I don't know if I have it in here, but I'm going to add it in here, right? So BULL. I never used them as a platform, by the way. I was looking at this chart recently, and it was very interesting to me. I'm going to look at a one-year chart. Look at this. This is what we call parabolic. What does parabolic mean? Parabolic means it shoots like to the moon super quick and super high. And then what happens when things are parabolic? It's not sustainable, right? And see how it crashed right back down again. So Webull right now, and by the way, this company makes money, so they're profitable. So when I hover over these little icons, these red and blue icons, it gives us the earnings per share. And I don't ever get too detailed. Listen, like you can have analysis paralysis with looking at stocks and stuff like that. And you don't want that to happen. You want to take action, right? You don't want to just like sit on the sidelines and I'm going to wait for that perfect trade setup, or I'm going to wait for this, or I'm going to wait for that. You'll be waiting forever. But one thing that I do look at is the stock profitable or is the stock not profitable, right? That doesn't mean that you don't want to trade it if it's not profitable, but it gives you a little bit more sense of stability, comfort, that kind of thing. At least the company's making money, right? So it's $8 per share, $8.10 per share. And if we were to look at, let's say, a 750 put, look at the high volatility, super, super high volatility. $19 ask, bid rather, 19 bid, 21 ask. Let's see the rate of return. I'm making $19 on my trade, and I'm putting up $750, so super, super low dollar amount, pretty low, making 2.5% on my money. Why is the percent so high? Because the implied volatility is so high. That's the reason. Now, the same person asked about Eli Lilly. I used to trade Eli Lilly a long time ago, and I haven't looked at it in a really long time. Holy cow, $1,000 a share. So let's take a look at it. So first we're going to look at this is the 1 year chart. So you'll see it's kind of like up, down, chops around, right? Like look at gaps will typically always fill, right? So a gap in the chart is when it either opens higher than the yesterday's high, or the low for this day is higher than the high for the previous day, right? So you can gap up or you can gap down, right? So gap down over here, right? And see how it fills, right? So once it kind of crosses against this like resistance right here, so this would be like the resistance mark, and then you'll see it kind of keeps going, right? And that's how gaps work, right? So I like gaps in the chart because it gives me like a sense of comfort of knowing, okay, well, maybe it went down, or it's going down, but most likely it's going to go up at some point, hopefully in the near future. So Eli Lilly is $1,000 a share. Let's take a look at the options. That's quite an expensive stock. So we're going to look at November 21, and we're going to go kind of closer to where it's trading. We'll see the implied volatility is around 50, 40%. That's pretty good. Not super volatile, not super conservative, or steady Eddie, but it's kind of in the middle, which is good. But you're putting up a lot of money, right? Because it's a high ticket sticker price, right? So $1,000. Let's say if you did $1,000 put, it last traded at $900. If you want to go a little bit more conservative, let's say a 980, but still you're putting up 98 grand. Now you can use margin, but you want to be careful with that. And I don't talk a lot about margin. I mean, I do sometimes. You have to be super careful with margin because, for example, let's say I wanted to trade a 980 put. I wanted to sell one. I'm going to click here, and then I'm going to right click or command click if you're on a Mac like me, and I'm going to hit Analyze Trade, and this is going to tell you what your margin requirement is, 16,000. Now, I want you guys to understand something. Now, I want you to understand this. So, for example, if I was selling the put, committing to buy 100 shares if it drops below 980, now I'm committing $98,000, right? $980 times 100 shares, 98,000. But the brokerage company is being so kind to only allow me to use a little bit of my money, let's say 16,000, right? In this case here, and I'm going to use the rest from the brokerage company. Why do they do that? Well, let's talk about that for a moment because I don't know if I shared this on any of these other live streams. I mean, first of all, they're going to look at how far away is it from where it's trading? How likely is it to go below 980? And then as the stock goes below, your account value is changing, right? So this is my net liquidity. Like that's like, okay, if I liquidated all my stuff in my account, how much money would I have, right? So I started this paper account, 25,000 last week. Now it went down a little bit, but just on paper. But as this number goes down, also sometimes your margin requirement changes because the price is changing. So what I mean in short is this: you don't want to have 16,000 in your account and that's it, and make a trade like this, because if the stock goes down, you're not capitalized enough. You don't have enough money in your account. And what happens is when you don't have enough money in your account, you get what's called a margin call. And depending on who you're trading with, so many years I traded with Interactive Brokers, and they're much more strict than Schwab. I can tell you that right off the bat. So for example, let's say if you have a margin call with Interactive Brokers, nobody's going to call you on the phone and say, hey, Jane Smith, you got to put some more money in, or otherwise we're going to liquidate your trade. No, they just liquidate it, and that's that. And if the price is coming down and you sold the put, let's say I got paid $450 on this put, as the stock is coming down, this could be trading at $900 or $1,000. It depends on how low it goes, right? And when that happens is when your trade gets liquidated, I just received $450 when I sold the put, and then I have to buy it back, right, when the trade gets liquidated at $1,000, and that becomes a realized loss. And realized losses, we really want to avoid realized losses as much as we can, and we want to focus on realized gains, right, because that's what gives us cash in our pocket every single week. So that's Eli Lilly, and that was Jerry's question that we had here. Let me see what other questions I have. What another bloody day in the market. All my puts that I sold a week ago are in the money. Yes, lots of things are down. Lots and lots of stock. I encourage you to, as stocks are moving, I encourage you to always pay attention to the price of whatever contract you're in. So let's say, I don't know, I'm just going to use an example. Let's say Amazon. I don't know, it's $231 per share. And let's say I sold a $200 or I don't know, 220 put or 210 put rather. And whatever I got for it, if you're making money and you have like a gain in that contract, I encourage you to always consider like, okay, if I was to buy that contract back, maybe I give some back to the market, but I'm also taking the risk off the table because the stock can keep sliding down and we don't know where the bottom's going to be, right? We can't tell the future. We don't have a crystal ball. Maybe the low goes lower. Maybe the high goes higher. Highs go higher and lows go lower. That's kind of like my saying. So you want to like take a look at that. So for example, let's see, Premium Willer, whoever this is with this message, that all the puts that you sold a week ago are in the money. Sometimes you can have a contract in the money, but it's still trading at a lower value than what you originally sold it for. So you want to take that into consideration and perhaps look at, I'm not saying buy it back, but we want to look at that, right? We want to be as best educated as we can moving forward. So yeah, good point. Let's see. So let's see what other questions I have here. Oh, I think I answered this before, but Nikki's question about selling at the bid or a limit order or market order. I just want to be specific. Yes. So when you trade options, you want to use limit orders, and when you trade stocks, I usually use market orders. Let's see. What do those letters mean next to the 70 bid? I think the letters that you're talking about are these, P, S, B, S, like those letters here. I'm not sure. I think what that is the actual market that trade filled on. So there's different, it's not just like one market that, let's say, fills all the Google contracts that go through for the day, but they're split amongst different places. So that's the actual routing that order went to. I ignore those. So I don't look at those. I don't know what exactly they stand for, but it refers to that. So you want to just ignore that. Let's see what other questions. I'm in coin at 227.50. So let's look at coin. Let's see. So coin is here. So this person says, where was that message? Oh, I can't see it now. Where did that go? It disappeared. Oh, right here, 227. So I'm going to think my orders are going off. I'm in coin at 227.50. I'm not sure if you mean you sold a 227.50 put, or maybe you're long shares at 227.50. But let's just take a peek at coin. I have coin myself as well, and Coinbase I think is very solid long term, but it's sliding because Bitcoin is sliding, right? So coin right now is down 8.25%, so down significantly. Another idea is if you wanted to, I mean, usually I look at 1 week contracts, but when things are so down for an extended period of time, and if they're making new lows, I mean, coin as an example was $444, a high back in July, right? And it's come down a bit. It kind of, gapped down, right? And then it filled this gap up here, but it's been sliding since here. So sliding for about the last 5 weeks or so, from 393, almost $400 down to 260, right? Maybe you want to look at something that goes out a little bit longer. Warren Buffett is an interesting guy. So he's super smart, and I'm not knocking him at all because he's Warren Buffett, right? Back in 2007, he doesn't talk a lot about options, and usually when he does talk about options, he's very negative about options. And I think his premise comes from buying options. So I mean, you can buy options, and that's kind of like a sucker thing, right? Like we want to, buy an option for a certain amount of money, and we're hoping to 10x our money, right? That we're investing if we're correct on the direction and we're correct on the timing. But he sold like billions of dollars of options in 2007, 2008 when the market was going down. And what he did was he did like long dated options. So 2007, 2008, the financial meltdown, right? Everybody's like freaking out and they think the world's going to end. But Warren Buffett knows, you know what? The world's not going to end, and the stock market goes up over time. And it does this, right? It goes up, it goes down, and then over time it goes up. So what did he do? He sold like super far out puts and collected oodles and oodles. I don't remember exactly the amount of money, but it was like billions of dollars in income. And he was committing to buy, like he did it on the indexes, right? So let's say the S&P 500 or something like that. So he wasn't doing individual companies, but he was saying, okay, if it's super down 5 years from now, I'm okay. I'm going to buy that. And he made billions of dollars. So let's say if we went out a few weeks, I don't know, let's go to the end of the year. December 26th is the last one of the year. And coin is super down. And it's down today, in fact, 8%. So that's the best time perhaps to sell a put. Let's say you don't have any Coinbase, right? As an example, but you believe in Bitcoin and you like Coinbase. I'm just giving you different ideas on how this might be applicable. You can sell something that's a little bit closer to the money. Let's say you sold a 260 put. Right now the price is at 261. Look at 260 put is going for $2,200. How does that work? You get $2,200 in your pocket right now, and you're committing to buy 100 shares if the price goes below 260 by the expiration date of December 26th. Now, it's important to keep in mind, anytime, this is super important, some of you might know this, and some of you might not know this. Once the stock goes below the strike price, you have to be like ready and able to buy that stock at that strike price, right? But in reality, most contracts get assigned at the expiration. And here's the reason for that. The reason is that most people who are in the options market are not necessarily hedging their position. So I give an example on selling a put. Okay, what's selling a put? Jane Smith in Idaho has 100 shares of Coinbase, and she doesn't want to lose all her money if the stock crashes. So she buys insurance, right? She pays me a premium. I'm like her insurance company, and I'm promising to buy her shares if her stock crashes. But in reality, there are people that are doing it that way. But in reality, most people are buying options because they're gamblers. They say, oh my gosh, I think coin is a terrible company, and I don't want to short it because I don't want to like have too much risk, but I want to buy a put. And maybe I only put up $2,000, but I can turn my $2,000 into $20,000, right? So if you're correct on the direction and the time, you can make a significant gain off of your investment. However, the likelihood of that happening is very, very small. So we're taking the other side of that trade, right? Because we're looking at it from like an insurance company standpoint, or like the house at a casino. Like, I'm Caesar's Palace and I'm making a little bit off of all these people pulling my slot machines. That's what we are as option sellers, right? And because of that, because of most of the players in the market are buyers of options, that means that most options will only get assigned when the contract expires. And here's why that's beneficial to you, right? When you sell options, especially if you went out a little bit longer. That means that like coin can like dip still, it can dip, it can dip. It's up to the actual person that's on the other side of your specific contract to assign it or not. Most of them don't assign until expiration. So that gives us an opportunity where coin goes down and then it pops back up again. So you always have the advantage of being an option seller. Yeah. So that's actually a good thing to know. Who knew that already? Who didn't know that? Let me know. I hope these sessions are really useful for you. Let's go through some more of these questions. I don't know. Can you guys see all the questions that are, or the chat? I think you can. Let's see. Yeah, so John answered the question I answered before. Those are the exchanges which they're getting the price from, or where it traded actually, or the price if it's in the case of a bid or an ask. Let's see. A lot of people want to create income for retirement. Yeah, for sure. Like, what is Social Security going to pay our way through retirement? Probably not. And as time goes on, things become more expensive, right? Like, what is that called? That's called inflation, right? So as time goes on, what I pay for, for a loaf of bread now is not what it's going to be, a year or 5 years from now. So you want to think about that ahead of time. Get out of debt, great strategy. Let's see. Big love to you. Big love back to you, Pamela. I need to make income. I'm on Social Security. Yeah, Social Security doesn't pay that much. So how about creating yourself a steady stream of income from week to week? Now, here's the thing about options. Even when you have stock and the price comes down, and let's say you're selling covered calls, right, against those shares, even when the stock price comes down, you only lose money if you sell your shares for less than what you paid. Don't do that. Worst case scenario, your income goes down, right? And if you have a trading account, most of you guys watching my videos, you're not living off your trading account income anyway. So the worst case scenario is you make less income maybe this week than you made last week, right? So it's something to keep in mind. Now you just want to make sure that you have enough money to keep averaging your cost down. That's like the key, right? My target is $100 extra a week. Just learning for now with a $5,000 account. That's great. I love that. And stay tuned because I'm going to open this new account with $5,000. I think that's a perfect number because a lot of people say, I think that's like a magic number. I'm starting with 5,000. I've heard that so many times. So I'm going to start my new account with 5,000 and you guys can just learn along with me. Let's see. Let me find some questions in here. Okay, here's a question. Actually, a few questions. If I sold MicroStrategy with a strike price of 210, now it is 193. Should I roll the put contract out further? Somebody's always talking about rolling on here on my channel. I love it. So here's the thing about rolling. I want you guys, I have a video I'm going to show you. Let me find this video. Let's see. YouTube, oops. YouTube, studio, content. Okay, I want you guys to watch this video because it's so good and I'm going to make another one soon. This video right here, right? This is the picture why I never roll options. Let me take a minute and talk. And also the event that I did last night has a whole piece. I think I talked like maybe for 15, 20 minutes on rolling. You don't want to roll your contracts. And let me explain why. Let me go back here and let me go back. Oops, shoot. Give me 1 second. Where was my... I lost my chat. Give me 1 second here. I don't know what happened to my chat, but I can see the chat right here. Here's what rolling means. Rolling means I sell a put here, and now the price is here, right? So I think, what was the MicroStrategy? So let me pull up MicroStrategy. I sold a 210 MicroStrategy, and now MicroStrategy is at 193. Rolling means this. I'm going to buy my put back, and then I'm going to sell another one on the same ticker, MicroStrategy, for next week at a lower price. Don't do that. And here's why. First of all, when you... No, I got it. I can look at it here. But thank you. Here's why you don't want to do that. First of all, when you buy your contract back, you are going to take a recognized loss, an actual loss. When you sell a put, you have to do it with the mentality of, you know what, I'm selling a put on MicroStrategy and my strike price is 210. And if I had to buy the shares, I'm going to buy the shares. And by the way, your cost basis is going to go down by the premium that you took in for the put. So for example, you have a 210 put on MicroStrategy, and let's say you took in, I don't know, $2 in premium, right? $200 or $2 in premium. Your cost basis is going to come down to 208. Now the price is only 193. It's not super far away. MicroStrategy, I mean, I'm not here and I'm not a fortune teller, but I would say MicroStrategy is going to go back up. I mean, Michael Saylor's amazing. Bitcoin is solid long term. It's maybe it goes down, maybe it goes down more, but it will come back up. When you're buying your contract back and taking a loss and then opening a new contract with the same ticker for next week, you're kicking the can down the road. Don't do that. Just buy the shares. And then if it does go down more, sell another put. So you want to avoid realized losses as much as possible. And you want to create yourself realized gains. And you also want to keep track of that on a regular basis every week. You want to have a spreadsheet, just a simple spreadsheet. How much money did I make last week? Realized gain wise. How much money did I make this week? How does that work? So that's important. And then also with rolling, the same thing on the covered call side. Like, I don't know, let's say lots of stocks are down right now. I don't know if I could just find a stock that's up. Or let's say Google's up. Okay. So let's say I had Google here, like 265, and then now it's 285. And let's say I sold a 270 covered call. Now, when you sell a covered call, usually you're going to do so with a strike price that's above the price at which you paid for the shares, right? Why? Because you want to recognize a gain, if the stock goes up. But sometimes what happens is the stock shoots up in the air and people will say, oh my gosh, I shouldn't have sold that call. I would have made blah, blah, blah. Don't do that. Listen, the absolute rolling is not good in my view. First of all, number one, you're doing what everybody else does. Like 90%, first of all, 90% of people who trade lose their money, I think, because they just they take on too much leverage. They don't necessarily have the bad trade, but they have too many positions. Lots of different reasons. They freak out when their stuff goes low and then they sell it and turn that paper loss into a real loss. So most people that trade, they don't do so successfully. And so don't listen to the majority of people that aren't successful. If I turn on a podcast, like so many people are talking about rolling their contracts, it's honestly like the I don't want to say the dumbest, that's such a negative word, but it's not the smartest thing to do. And for sure, never roll a covered call where you're making money. So in my example with Google, let's say I buy Google and I sell a covered call against it, and let's say the stock shoots up to the moon. I mean, it didn't here, it went up a little bit, but let's say it shoots up really high. They buy their contract back, lose money, right? Then they sell a new contract for next week, and maybe they netted money overall, so they lost less money than they made in the new contract. It's a bad idea. You still recognize a loss. You don't get away from that. You still have a realized loss, and then you already had a winner. Why would you try to like make your winner a bigger winner? Just take the winner. You know what I'm saying? So options trading is about like hitting singles. Like you're a baseball player and you're just hitting singles and you want to win the game. You don't want to swing for a home run. So don't do that. So in answer to your question, don't roll. All right. I'm going to look at the chat here. I know it's kind of fuzzy on the screen here. Lady Trader says she doesn't recommend to roll it over, but it's your choice. That's absolutely right. Listen, your money is your money, guys. You might say, you know what, Michelle, I don't think that doesn't sound right to me, and I'm going to keep rolling. Do what you feel is best. But I personally think it's the biggest mistake. And also going back to like, if you do what everybody else does, you're going to get what everybody else does, or gets rather. Do what only a few people do. That's why all the amazing stuff is like on the other side of your comfort zone. Do the stuff that nobody does and get all the amazing stuff that nobody gets. Yeah, so that's kind of how I look at it. All right, let's go through a few more questions. It's so interesting. Like sometimes I feel like, okay, I got 30 minutes, or sometimes I feel like let's go an hour. I'm just like winging it, I guess. But hopefully this is helpful, and there's still a bunch of people on, so it's all good. Last week I bought CCJ, $93 put, and it dropped down to 83. I think you meant to sell you. I think you meant to say that you sold a CCJ 93 put, and it dropped down to 83. I let it get assigned, and today I sold a covered call on it. Bravo, bravo, bravo. That's what you want to do. So when you sell a put, you're already saying ahead of time, you know what? If the stock goes down to this price, I'm going to buy those shares. And on Monday, I'm going to sell a covered call against it. Now, if it drops a lot, calls maybe won't be worth that much, but you can still make a little bit of money. Or you can maybe wait until it pops back up a little bit and make more money. A lot of this stuff is like, as you get experience, it's like a dance. You're going to like find your groove, right? Well done. Selling a covered call. Let's see. If you believe in the stock, you can probably find a better entry. I don't really try to time stocks. So here's the thing. I never fool myself into thinking that I can pick a bottom or pick a top. The most important thing for me is like the ticker, right? Do I like this company, right? Like, is it a solid company long term? And then I just sell puts and calls. And then, I go with a low delta if I kind of don't really want to buy the stock that much. Or if I already have some shares and I want to average my cost down, maybe I go with a higher delta. But I try not to really like focus too much on the money, like the price part of it, because I don't know if it's going to go higher or if it's going to go lower. And I want to make money regardless because I got stuff to pay for. Let's see. Let's see what other questions. Do you have an idea on why the market is making such a big dip right now? No, I don't. I mean, I know like Coinbase is down because Bitcoin's down. That happens sometimes. I try to listen. Here's how I think about things, guys. I can only fit so much stuff up here. like I don't want to put anything in my brain that doesn't like help me accomplish something. I have no idea why the market's going down, but I know the market goes up and it goes down all the time, and it doesn't matter why. So I'm not sure. Let's see. And what percent do you recommend between NLV and MM? Net liquidation value and money market, I think is what you're asking, perhaps. Like how much cash should you invest? I am putting together some applications that help people calculate that better. It becomes a very mathematical thing, especially when you have like short puts or if you have long shares and you have different tickers. Rule of thumb, like you don't want more than, let's say, 10% of something in an account, or maybe 20% of one particular thing. It's also good maybe to have some non-correlated stuff, like, if you have, let's say, Coinbase and MicroStrategy and IBIT and Mara, just as an example, like all like crypto type stuff, crypto goes down and you're going to, slide down a little bit more. So sometimes when you have like stuff that's not necessarily correlated, it's always a good idea as well. Good question. Many people roll and are successful. Okay, well, how do you know that? That's what if you don't have the money to average down? Then if you don't have the money to average down, then you took the wrong position in the first place. So first of all, I would push back on that comment. When somebody says many people roll and they're successful, how do you know that? Like, why? Because they said that? How do you know? I don't know. And maybe you don't know if I'm successful either. I mean, you don't know me. I'm just some chick on YouTube, right? But I can tell you that I've been doing this for decades and I live off my income. So that's a little bit of a substantiation. I would beg to say that, like, I don't know, have they been trading like a year and they've been successful so far rolling and No, rolling. You can roll if you want Hawaiian skies. You can roll all you want. It's your money, bro. But I think it's just a bad mistake, and that's why I'm passionate about it because I think that people sometimes can become like uh, hypnotized sometimes by the views of other people and by the thoughts of other people, and maybe do your own due diligence. Like maybe think, okay, well, these people say that they roll and they're successful. Michelle's saying it's like probably the dumbest thing in the world. Like, what's the middle ground? I don't know. Maybe do a little bit more research. If you look at that video that I showed you, there were a couple commenters on there that rolled. The worst thing to do is roll a covered call that you already made money on. And I think that there's no, that I can't see any argument in support of rolling a covered call that's your shares are going to get assigned and you made money and it's over your basis. I can't see any reason why anybody would do that. There's a couple of people on that that commented, because I read all the comments, by the way, and it's me personally that's replying to those. I don't have some admin doing it for me. There's a couple of people on there that said, "Hey, I rolled, I don't know, I rolled when it was $80, now it's $400," and they're kicking the can down the road every day. If you don't have enough money to average your cost down, then you got to choose a different ticker. Then your ticker is not the right ticker for your size account. There's going to be tickers for every size account. When I do this $5,000, when I open this account and I do this $5,000, you can trade right along with me. There's tons of things. I like Mara. I used to trade Mara a lot. Mara it's another Bitcoin company. 11 bucks a share. Let's see. There's a couple good ones that people talk about. ETHA is 22 bucks a share. Lyft 21 bucks a share. I don't know. BBAI is $6 a share. I'm not specifically recommending those, but there's no shortage of tickers for whatever your budget is. You just got to look a little bit harder, is all. But good point. Let's see. What if for some sell puts you need margin, for some less expensive you don't? How does it work? I'm not sure I understand that question. The way that you want to see how much margin is required, the easiest way is just to look on the platform. So let's look at IBIT as an example. And I want to, let's say, sell a November 21, $51 put. I'm just going to click on it to bring up my order entry window here, right? So I'm selling one IBIT November 21, $51 put. I'm going to command click it, right? And I'm going to analyze the trade. So that's the easiest way to look at it. And then that shows us what the margin is, $700, $694. Now this number is going to fluctuate, right? So margin is typically, it might also depend on what brokerage you're with. So like, let's say you're with, I don't know, Webull. It might not be the same as what Schwab says the margin is. And also the brokerage has flexibility to change the margin requirement at any time. So let's say a particular ticker that you're trading starts off where you need, let's say 30% to put up to make that trade. And if it becomes more volatile, they might increase that from 30% to 50% or whatever the number is. Margin is like a very convoluted, I would say, thing. I really need to carve out some time. I have an application that I use where I download my positions and then I can put in a hypothetical. Okay, if this ticker drops, X percent, does that trigger a margin call? I think everybody needs that. And I'm in the process of creating that for everybody to use. I just need some time, man. Like those things are just time sensitive and takes time to do it. Let's see. Oh, maintenance margin. So NLV, net liquidity value. I think your net liq value and your maintenance margin. I don't really look at percentages. The way I handle my margin account is I use what I just mentioned, which is a spreadsheet that says, okay, if MicroStrategy goes down 50%, am I going to get a margin call? Yes or no. Like, where's that going to put my total account value? It's going to be easier when I show you in a real account, because here, it does show you option buying power. So this shows like how much cushion you have, $20,000, in order to make new trades and cover the positions that you already have. I don't know if that really answered your question. I think it kind of did. Let's see. We're going to go through a couple more questions. If you can only get $2 for your covered call in a weekly, do you take it? Do you go out further, or do you sit on it until it comes back? That's a good question. It really depends. There's a lot of this stuff. There's really like not this right or wrong answer. Here's how I look at trading. Am I making money? Am I making realized gains from week to week? And am I losing money? Am I taking realized losses? When your tickers are down, you make less money. If I can make $200, I know it's all relative. Like some people think $200 is not a lot of money. Some people think it is a lot of money. I think, oh, that's the market closing, 4 o'clock. I think $200 is a lot of money. Usually on expensive tickers. Me personally, I usually trade like MicroStrategy, Coinbase, Tesla. Those are kind of like higher dollar tickers. And usually when it's kind of like close to the money, you're getting $500 a contract. So it gives you some healthy premium. And right now, MicroStrategy, is so down. As an example, I wouldn't sell a MicroStrategy call for, $20 or something like that. I would wait until it has a little bit of a pop and then take in more income. Somebody said the one and only time I rolled, I was not successful. Here's the thing, also, and I want people to recognize this. It's not about making money today or next month or even next year. It's about being sustainable. It's about making money on a regular basis for the rest of your life. So it's kind of like a broken watch. I don't have a watch on as I look at my wrist. It's like a broken watch is correct twice a day, right? Does it mean it's not broken? No, it just means like it's right twice a day. This is the same thing. Yeah. Let's see. So I know them personally. They overall make money rolling. So you are saying you should have the money to average down. Yeah. So I would say do what you feel is comfortable. Hey, I'm not a guru, right? I've been doing it for a long time, but that doesn't make me a guru, and that doesn't make me 100% right. And I don't think anybody's 100% right. I'm just trying to help. I think if you don't have the money to average down your basis, I would choose different tickers. Let's see. Can you put the link in here for the spreadsheet? I don't know how to do that, but let me show you where the spreadsheet's at. I'm showing you guys all my stuff here, huh? Look at my percentage of likes. I always see the percentage of likes, always like 90-something%. Here's the video that has the spreadsheets. This video here. ChatGPT sometimes does my thumbnails. It's such a goofy looking thumbnail, so ignore that part. But sometimes it's for shock, so it's all good. But here's the, let's see. It's in a pinned comment. It's not here, but it's in a pinned comment on this video here. There's 2 links to spreadsheets. Thanks for asking. Appreciate that. And they're really good spreadsheets, by the way. All right, we're going to go through another, one more question, and then that's it. Well, actually, I'm going to do 2 more questions. Will any of my option orders fill in the aftermarket? No. So options trades only fill while the stock market's open, right? So stocks can fill in the aftermarket, like, in the US is closed, other countries are trading. So you can buy or sell stocks, but you cannot buy or sell options. Now, if you're the owner of a contract, the owner of a contract has, I think it's like, I'm not even sure, maybe it's an hour and a half or 30 minutes or something like that. Let's say your contract expires on a Friday, right? At 4 o'clock when the market closes, Eastern time. The person that owns that contract can manually assign that contract until like 5:35 p.m. or I'm not sure exactly what time it is. So that's the only thing that can happen after the market closes. Let's see, the spreadsheet only downloaded. No, the spreadsheet is a numbers file. So the spreadsheet is, I'm a Mac person, so I use numbers, but you can very easily open it in Excel or open it in Google Sheets or something like that. If you're not sure how to do that, I think Google can just tell you. It's not a PDF, and the purpose of being an actual spreadsheet is you put the data in and it automatically updates it for you. Check it out; it's going to be really good. Anyway, what percent? I'm going to do one more question. I keep saying I'm going to do one more, and then that's it. What percent return on a put to close it out? It really depends. Certainly, like when I make 90% of my money on a put, I think, okay, let me just close that out. Or if I can close something out for like $2, $5, something like that, I do that because what if something big happens, catastrophic happens, and that slides all the way down? Like, why not just take the risk off the table? I'm a big believer. It's so easy to make money and it's harder not to lose it. Take the risk off the table is my motto. Anyway, I hope that helps. Went a little bit longer. Stay tuned. I am going to, over the next few days for sure, I'm going to open a new account and I'm going to record it as I do that, right? So I'm going to open a new account, I'm going to record it, and I'm going to put it up as a YouTube video. And that way people can kind of like walk along and see, like, I don't remember what those questions were as far as your experience level and that kind of thing with trading, to have authorization to be able to trade options. It's not that hard, but it's just some paperwork that you have to do. Anyway, I want to say thank you. I mean that from the bottom of my heart. Even the people that like have different thoughts and beliefs as I do about rolling, let's say as an example, I appreciate your pushback, right? I like dialogue. Like it's important because, like, hey, there's nothing worse than somebody that thinks they know, they're certain about a thing, and then they're actually it's the wrong thing. So I guess what I'm trying to say is I appreciate all your questions, all your comments. I appreciate you being here, whether your your opinion is the same as me or not. It doesn't matter. I appreciate you expressing that. And yeah, stay tuned for that session that I did last night. I'm gonna hopefully finish editing that video today and put it on YouTube. And I'll see you guys Wednesday, same time, 3 o'clock. Thanks for joining.